What if I told you the fastest way to blow up your trading account is the same thing that makes you feel like a genius on day one? January 2021. A college student I knew turned $5,000 into $50,000 overnight on GameStop. His phone lit up with notifications, friends sending rocket emojis, bragging about their own wins. He felt unstoppable, like he had cracked the market's code. But 2 weeks later, that 50,000 was cut in half. He doubled down, convinced the bounce was coming back. His confidence turned into stubbornness. And by the time he finally sold, almost all of it was gone. That story isn't unique. It's the same trap I've seen retail traders fall into for years. Bitcoin in 2017, Tesla options in 2020, meme stocks in 2021. Quick wins feel like proof of skill. But they're usually just luck colliding with overconfidence. And when the tide turns, luck vanishes faster than your balance. Here's the truth: anyone can catch a wave. But surviving long enough to build real wealth takes something else entirely. Rules, discipline, and a mindset strong enough to cut losses before they cut you. In this talk, I'm going to share lessons from one of the most fascinating experiments in trading history, Richard Dennis's turtle traders. Ordinary people, given a system of rules, became millionaires. And those same principles can protect you from the traps that destroy most traders today. By the end, you'll know how to spot when psychology is steering your trades, how to size risk so you never blow up, and how to build a system that keeps you calm when markets get wild. Because success in trading isn't about predicting the future, it's about surviving long enough to let the rules do the work. My name is Ben, and welcome to ZenStock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. And if you find value in what we share here, hit like and subscribe. We need your support to keep growing this channel and bringing you more content like this. Back in the 1980s, a Chicago trader named Richard Dennis made a bet that would change market history. He believed trading could be taught, just like math or chess. His friend Bill Eckhart disagreed, saying it was instinct, something you were born with. To settle the debate, Dennis launched an experiment. He recruited a group of complete novices, taught them a simple set of rules, and turned them loose in the markets. The story is captured in Michael Koval's book, The Complete Turtle Trader: How 23 Novice Investors Became Overnight Millionaires. Koval reveals how these ordinary people, nicknamed the Turtles, became proof that discipline and rules could beat raw intuition. It's one of the most powerful reminders that success in trading isn't about genius. It's about following a system, even when your emotions scream at you to do the opposite. And here's the key: those same lessons apply to every trader today. Whether you're in stocks, crypto, or futures, the psychology hasn't changed. The market still punishes emotion and rewards discipline. Which side of that equation you fall on depends on the rules you choose to live by. When I first started trading, I thought skill meant predicting the next big move. I spent hours staring at charts, convinced I could outsmart the market if I just spotted the right pattern. And when I caught a few lucky wins in a row, it felt like confirmation. I told myself, I've got this figured out. But then reality hit. One trade in particular still stings. Back in 2012, I went heavy into Facebook right after its IPO. Everyone said it was the future of the internet, and in the long run, they were right. But I wasn't thinking long run. I was chasing a quick score. At first, the stock looked strong. Then, within weeks, it collapsed from $38 down into the teens. My account bled red every single day. I froze, telling myself it had to bounce back. Instead, the losses deepened. By the time I finally sold, I had erased months of progress in a single decision. That moment changed me. I realized I wasn't trading the market. I was trading my emotions. Fear of missing out pushed me in. Ego kept me from cutting the loss, and pain avoidance made me hold far too long. Here's where the lesson came in. Rules would have saved me. A stop loss written down before entry. A limit on how much I could risk on one trade. A system that didn't rely on gut feeling but on discipline. The same foundation Richard Dennis drilled into his turtles decades ago. And I'll be honest with you, I see this exact cycle play out with new traders I've mentored. They win early, feel invincible, double down, and then hit a wall. Some walk away from trading forever. Others finally wake up to the truth. You don't survive by predicting. You survive by preparing. That's why I wanted to share my own early missteps with you, because the turtles learned the same lesson. Great training and strategies weren't enough unless they paired them with courage, discipline, and a refusal to let emotions dictate their next move. So here's the real question for you. Are you trading your system, or are you trading your emotions? The lesson from my Facebook trade and from the turtle traders is simple. Winning in the markets isn't about being the smartest person in the room. It's not about calling tops and bottoms or guessing where the next breakout will come from. It's about rules, discipline, and building a mindset strong enough to keep you steady when your emotions want to hijack the wheel. That's the focus of today's talk. We're going to dive deep into how the turtles learned to manage risk, exit losers quickly, and stay calm when others were panicking. And along the way, I'll show you how those same lessons can transform your own trading psychology. Now, quick reminder, this content is for education and entertainment only. It's not financial advice. Always do your own research before you put real money at risk. Here's the truth. Success in trading isn't magic, and it isn't luck. It comes down to rules that protect you from yourself. The turtles proved that ordinary people could become extraordinary traders if they followed the system and ignored the noise. So here's where we're headed. We're going to deep dive and find out exactly how the turtles did it, how they sized their risk, how they managed losses without ego, and how they built the kind of discipline most traders only dream about. Stay with me, because the details you're about to hear can change the way you trade forever. One of the first rules Richard Dennis drilled into the turtles was brutally simple. If you lose money in a market, move on. Don't fight it. Don't linger. Just exit and live to fight another day. Koval captures it in The Complete Turtle Trader. If the turtles lost money in a market, they had to move on. Accepting and managing losses are part of their game. Now, on paper, that sounds easy. But let's be real. Cutting a loss in the moment feels like admitting defeat. Ego whispers, it'll come back. Loss aversion convinces us that pain avoided now will magically turn into profits later. And yet, that refusal to exit is exactly what destroys accounts. I remember mentoring a trader in 2018 who bought into GE during its massive decline. He kept saying, "It's too cheap to go any lower." Every time it dipped, he added more. By the time he finally sold, he had lost over 70% of his position's value. It wasn't the stock that killed him, it was his refusal to let go. And here's the kicker. I've seen that same trap repeat in crypto, tech stocks, even penny stocks. The market doesn't punish the trade, it punishes the refusal to accept you're wrong. Behavioral finance research backs this up. Studies show traders experience losses at roughly twice the emotional intensity of gains. Kahneman and Tversky, 1979. That pain avoidance bias keeps us holding losers far longer than logic allows. And yet, the best traders do the opposite. They cut, move on, and reallocate to the next opportunity. The turtles survived because they trained that instinct into a rule. No negotiation, no exceptions. Loss equals exit. So here's my takeaway. Managing losses isn't just a risk strategy, it's an ego strategy. You're not just fighting the market, you're fighting yourself. Pre-commit your exit. Before you enter a trade, write down your stop price. Don't trust yourself to decide in the heat of the moment. Think in streaks, not single trades. A loss today doesn't define your edge. Your edge plays out across dozens of trades, not one. Ask the turtle question. Every time you hesitate on a loser, ask, if I had no position right now, would I enter here? If the answer is no, you already know what to do. The turtles didn't survive by being right all the time. They survived by making sure their wrong trades didn't take them out of the game. Ego wants to win this trade. Discipline wants to win the next 100. So let me ask you, which one is running your trading right now? One of the most liberating turtle lessons is this: don't waste energy trying to predict the future. Dennis taught his students to focus on rules for entry and exit, not crystal ball guessing. Or as Covell put it, don't try to predict how long a trend either up or down will last. It is impossible. That single rule is a gut punch to most traders. Why? Because prediction feeds our ego. It feels good to be the one who called the top or nailed the bottom. But the turtles didn't play that game. They accepted that the future is unknowable. Their job was to prepare, not predict. I'll never forget a conversation with a friend during the 2020 oil crash when crude futures briefly went negative. He said, "No way oil can drop below zero. Impossible." He bet big on a rebound. And for a moment, it looked brilliant. But then the contracts collapsed into uncharted territory. He lost half his account in one move, not because the trade was inherently wrong, but because he believed he could see the future. His confidence blinded him to the possibility of the impossible. That's the illusion of control at work, a psychological trap where we believe outcomes bend to our will simply because we want them to. Academic studies back this up. In a 2006 study on trader psychology, researchers found that overconfident traders traded up to 45% more frequently than disciplined peers and underperformed them by wide margins. The takeaway? The more certain you think you are, the more the market humbles you. The turtles sidestep this trap by anchoring their decisions in observable facts, breakouts, volatility, and risk limits. Not opinions, not predictions, just rules that said, if X happens, I act. If Y happens, I exit. So here's the shift. Stop treating trading like fortune telling. Start treating it like preparation. Write down what conditions must be true before you enter. Define your exit before you place a trade. Then let the market reveal which side unfolds. Your job isn't to guess, it's to respond. Adopt if. Then trading. Every trade should be framed as, if X happens, then I act. No predictions, just conditions. Ban future talk from your journal. Instead of writing, I think this stock will rise, write, if it breaks this level, I enter. If it hits this stop, I exit. Practice humility. Each time you feel certain, remind yourself, certainty in trading is an illusion. Your only real edge is preparation. The turtles didn't waste time debating whether a trend would last. They knew it was unknowable. They prepared to act and then let the rules do the heavy lifting. The question is, are you still trying to play fortune teller, or are you building a plan that keeps you safe no matter what the market throws at you? Richard Dennis knew that the fastest way to knock a trader out wasn't bad predictions, it was oversized bets. That's why the turtles were taught to cut risk as their accounts drew down. For every 10% they lost, they reduced their trading size by 20%. It was discipline baked right into the math. As Covell wrote, discipline, money management, and patience were the only ways it would work. That rule didn't just protect their capital, it protected their psychology. Because oversized positions don't just drain your account, they hijack your emotions. Suddenly, every tick feels like life or death. Fear and hope, battle it out on every candle. And that's when rational decisions disappear. I remember a friend in 2015 who went all in on Valeant Pharmaceuticals. The stock had soared from $20 to over $200. He was convinced it would never come back down, but when the accounting scandal broke, Valeant collapsed. He froze, unable to sell, because the position was too big. Within months, he lost nearly everything he had put in. It wasn't just a financial loss, it broke his confidence. He quit trading altogether. Contrast that with the turtles. Even when they hit drawdowns, they survived. They didn't blow up because the system forced them to scale risk down before their emotions spiraled out of control. Behavioral finance explains why this works. Studies show that traders who risk more than 2 to 3% per trade experience elevated cortisol levels, impairing decision-making. In plain English, too much risk literally rewires your brain into panic mode. That's why scaling risk down isn't weakness, it's armor. So here's the shift. Position sizing isn't just about protecting money, it's about protecting your mind. When you risk small, you can think clearly. And when you think clearly, you make better decisions. That's the real compounding effect. Never risk more than 2% of your account on a single trade. For a $10,000 account, that means a $200 risk max. Reduce size by 20% for every 10% drawdown. It forces humility before the market forces it for you. Use volatility-based stops so your position size adapts to market conditions, not your emotions. The turtles didn't survive because they never lost. They survived because their risk was never big enough to kill them. That's why I call position sizing emotional armor. The market will always attack. The only question is, are you armored up, or are you walking in unprotected? One of the most overlooked turtle rules was also the most counterintuitive. If there was no trend, they didn't trade. Covell wrote, "No trending market, no profit, no market moves, no calling Robert Moss to place trades." In other words, if the ocean was flat, they stayed on the beach. Sounds obvious, right? But let me ask you, how many times have you forced a trade out of boredom? How many times have you stared at a sideways chart and thought, something has to happen soon? That urge to act is one of the most destructive forces in trading psychology. I've lived it myself. Back in 2014, during a quiet summer stretch, I was desperate for action. The market wasn't moving, but I convinced myself I could scalp a few points in low-volume conditions. Instead, I racked up a string of small, meaningless losses. By the end of the week, I wasn't down because the market was hard. I was down because I couldn't sit still. That's impatience in action. Overtrading not only drains your account, it erodes your discipline. Every time you take a bad trade, you reinforce the habit of acting without a real edge. And psychology research confirms this. A 2019 study on risk behavior found that boredom significantly increases impulsive decision-making. Traders under boredom conditions took over 25% more unnecessary risks compared to those who waited patiently. The turtles avoided that trap by turning boredom into a rule: no trend, no trade. Here's the paradox. Boring trading is often the most profitable kind. The best trades are rare. The discipline is in waiting for them. So here's the shift. Stop treating trading like constant entertainment. Start treating it like professional hunting. You don't fire at every rustle in the bushes. You wait until the target is clear. Set no trade rules. If volatility and volume are below your thresholds, step away. Use waiting rituals. When conditions are flat, replace screen staring with analysis, journaling, or reviewing past trades. Channel the energy. Track boredom trades. Mark every trade you took just to do something. Seeing the cost on paper will shock you into discipline. The turtles proved that waiting is a strategy. Doing nothing is a decision. And sometimes, it's the decision that saves your account. The real question is, do you have the patience to wait for your edge, or are you still chasing trades just to feel alive? At the core of the turtle strategy was a philosophy as old as science itself, Occam's razor. Or, in Dennis's words, keep it simple, stupid. Their trading rules weren't loaded with indicators, oscillators, or exotic algorithms. They were simple breakout systems, volatility measures, and risk limits. That simplicity wasn't a weakness. It was the reason they worked. But most traders resist simplicity. I see it all the time. A new trader fills their screen with 12 indicators, each one flashing a different signal. Moving averages cross, oscillators diverge, Fibonacci levels overlap, and instead of clarity, they get noise. They freeze, waiting for confirmation that never comes, or worse, they cherry-pick whichever indicator agrees with the trade they already wanted to take. That's confirmation bias dressed up as analysis. I fell into this trap myself. Early in my career, I convinced myself that if I just added one more indicator, I'd finally find certainty. My charts looked like airplane cockpits. But the more complex I made them, the less confident I became. It wasn't until I stripped everything down to price, volatility, and exits that I started to see consistent results. The turtles understood that complexity is seductive, but deadly. The more moving parts, the more excuses you give yourself to override your own rules. By keeping their system simple, they eliminated loopholes for their emotions to sneak through, and the research backs it up. A 2012 study on decision-making found that people presented with more than 5 simultaneous inputs experienced drastically reduced accuracy, even when more information should have helped. More signals don't mean more clarity. They mean more confusion. That's why the turtles thrived with basic breakout rules. Simple didn't mean easy. Simple meant repeatable. Simple meant they could execute without hesitation, even when fear or greed screamed at them to stop. So, here's the shift. Complexity is often just procrastination in disguise. You don't need more indicators, you need clearer rules. Strip it down, keep it simple, trust the system. Run a chart cleanse. Trade with just price and one volatility measure for a month. Notice how much cleaner your decisions feel. Set a max indicators rule, no more than 3 tools on your screen. If you can't explain each one in a single sentence, cut it. Journal complexity traps. Anytime you find yourself adding a tool or hesitating for confirmation, write down what emotion you're trying to soothe. The turtles didn't become millionaires because they had the most complex system. They became millionaires because they had the simplest system and the discipline to follow it. The question is, are you complicating your trading to feel smarter or simplifying it to actually win? All of this sounds clear when we talk about it in hindsight. But in the heat of the moment, psychology takes over. And that's where most traders fall, not because they don't know what to do, but because their mind convinces them to do the opposite. So let's talk about the biggest traps that sabotage traders again and again, and how the turtles learn to sidestep them. Here's the brutal truth. Most traders don't fail because of the market. They fail because of themselves. And time after time, I see the same psychological traps repeat. Trap 1. Loss aversion. This is the most dangerous one. The pain of taking a small loss feels worse than the relief of taking a small win, so traders hold and hope. I've seen traders watch a 5% loss turn into a 50% disaster because they couldn't face the pain of closing. The turtles solved this with hard stops, no questions asked. Loss equals exit. Trap 2. Overconfidence and illusion of control. 1 or 2 lucky wins, and suddenly we think we can see the future. Meme stock traders in 2021, crypto chasers in 2017, they all felt unstoppable. Until the market humbled them. The turtles cut this trap at the root. They didn't predict. They prepared. Rules stripped away the illusion that they were in control of outcomes. Trap 3. Impatience and overtrading. This one wrecks more accounts than people realize. Traders hate waiting, so they force trades just to feel active. But boredom is not a signal. The turtles had the discipline to wait. No trend, no trade. That patience was their edge. And here's the kicker. These traps aren't rare. They're built into human nature. Which means the only way past them is to design your trading system to protect you from you. So how do you protect yourself from these traps? You don't just tell yourself to be more disciplined. That doesn't work. You need tools, written rules that act as guardrails when your emotions try to hijack the wheel. Here are 2 that have saved me and countless traders I've worked with. Before you enter a trade, write down 3 things: your entry level, your stop loss, and your position size. No exceptions. If the trade doesn't fit the plan, it doesn't get placed. The act of writing forces you to confront reality before the adrenaline kicks in. This is exactly what the turtles did. They had their exits defined before their entries ever went live. Never risk more than 2% of your account on a single trade. If your account is 10,000, that's 200 max. The beauty of this rule isn't just protecting capital, it protects your mind. When you know you can only lose a small, defined amount, the fear disappears. You can actually think clearly instead of panicking at every tick. Trading isn't about having perfect predictions. It's about having rules strong enough to hold you steady when your instincts want to do the opposite. These 2 tools, a written plan and fixed risk per trade, are simple. But they're the exact kind of simplicity that made the turtle system work. And they can work for you too if you actually use them. When you look at your last 5 trades, were they based on a written plan or on a gut feeling? If your stop hadn't been hit yet, would you still want to enter that same trade today? Or are you only holding because you can't stand the thought of taking a loss? And here's the hardest one. Are you trading a system that protects you, or are you letting your emotions call the shots? The turtles answered these questions every single day through their rules. That's why they survived. And the way you answer them will shape whether you keep repeating the same traps or finally step into disciplined, rule-based trading. Here's the bottom line. The turtles weren't superhuman. They weren't born with some secret gift. They were ordinary people who followed extraordinary rules. And those rules, cutting losses fast, preparing instead of predicting, sizing risk, waiting patiently, keeping it simple, are timeless. They're just as powerful for you today as they were in the 1980s. But here's the key: they only work if you use them. Knowledge without action is just another trading book on the shelf. Action is what rewires your psychology. Action is what builds discipline. Action is what keeps you in the game long enough to win. So here's my challenge to you. Write down the biggest lesson you're taking from this video in the comments. Share this with a friend who's struggling with discipline. And if you found value here, hit like and subscribe. We need your support to grow and to keep bringing this kind of content to traders who need it most. Remember this: master your mind, master the market, trade with confidence, and live with calm. You're not trading alone. Join me in the next video above, where we keep breaking down the psychology that shapes every trade.